Good afternoon, ladies and gentlemen. Thanks for being with us. I'm Alex Pollock of AEI, and it's my pleasure to welcome you to this conference today on the FHA from 1934 to 1938, Lessons for Wealth Building. A favorite phrase of mine is the egocentricity of the present. This means, among other things, that we have a very common bias among people in the present that somehow we must be smarter than people of previous times were. Now, the FHA, as we know, was created 80 years ago in 1934. Could people 80 years ago know anything about what makes sound mortgage credit? You bet they did. Ed Pinto's highly interesting research into the early years of the FHA, which you are about to hear summarized, demonstrates that those people of 80 years ago probably knew more about sound mortgage credit than people today typically do, because little by little over the decades we forgot what they knew. Ed is going to present his research for about 45 minutes this afternoon, after which we'll hear comments from two distinguished discussants, whom I will introduce at that time. After their comments, we'll let Ed respond, give the panel a chance to discuss the ideas among themselves, and then open the floor to your questions, including questions, if we have any, from those watching by video who can send in questions by email, and we will adjourn promptly at 2 o'clock. Our main speaker, Ed Pinto, is an AEI resident fellow and co-director of AEI's International Center on Housing Risk, and let me say, it is hugely fun to have Ed as a colleague. He's currently developing policy options for rebuilding the U.S. housing finance sector, specializing, as he does, in the distortions created by government housing policies on mortgages, foreclosures, and the availability of affordable housing. With our colleague Steve Oliner, who has Ed has developed the AEI Pinto Oliner Mortgage Risk, Collateral Risk, and Capital Adequacy Indexes. Previously Executive Vice President and Chief Credit Officer for Fannie Mae, Ed has done groundbreaking research on the role of federal housing policy in the 2007 and 2008 mortgage crisis, and on the continuing unfortunate influence of the massive government mortgage complex. In December 2012, Ed completed a study of 2.5 million FHA-insured loans and found that FHA's policies resulted in an excessive proportion of their borrowers losing their homes. As you will see from the displays hung around here today, Ed has been doing a lot of research on the history of the FHA, and I believe this research has made him far and away the leading expert of the history and the credit concepts of the early FHA. Ed, you have the floor.
Newsreel. This is 1934, I believe.
1928 was a good building year. Almost $3 billion worth of new residential construction saw the light of day. But in 1929, even before the Depression became general, building dropped off to slightly under $2 billion. Year after year throughout the Depression, this decline continued, each succeeding drop meaning thousands more men laid off in the building and allied industries. Until in 1934, all of the new homes built in the United States were worth only $227 million. A decline of 92% from 1928. But due to the stimulation of the National Housing Act, 1935 presents a different picture. From every section of the country come reports of vastly increased building activity. Now in these pictures, we show you a few of the thousands of houses of all types that are currently under construction as a result of this building boom. We show you a few of the hundreds of thousands of men whom it has put back to work, some of them after years of idleness. Carpenters, bricklayers, masons, plumbers, men from every division of the building trades are getting an honest day's work. And this reemployment is not limited to the building trades. For every man put to work on a house, several more are engaged in making the needed materials and transporting them to where they are to be used. This coffee and that comes out of a pay envelope tastes a lot sweeter than the same food when it's bought with a relief check. This tidal wave of new construction is an important contribution to the economic rebuilding of America. Homeownership is the basis of a happy, contented family life. And now, through the use of a National Housing Act insured mortgage, is brought within the reach of all citizens on a monthly payment plan no greater than rent.
Well, it's a pleasure to be here, and before I begin with the formal program, I need to recognize Alex, because he's the one that actually got me started on FHA. I believe I was over here visiting Peter before I even became a fellow here, and I was walking by Alex's office, and he grabbed me, as he just grabbed Steve, and said, just got a request to speak about or testify on FHA, but I can't do it. Are you interested? And the fool that I am, I said, sure. And that was, I think, in 2009. And that was the beginning of my in-depth research at FHA. I was, of course, familiar with it from earlier years. But that was the beginning. You have in your folders a vintage copy of 1935, the first consumer brochure, second edition, of FHA's housing program, single-family housing program, which was referred to in the newsreel. You also have a facsimile copy of the next year's pamphlet, 1936. And as Alex said, I've been researching. You see posters up here from FHA, all dated 1935, 36. Actually, some go back to 1934. And so it's a relevant topic given FHA's 80-year anniversary this year. What I found was that the thought leaders of the first half of the 20th century, both in underwriting and appraisal, there consisted of 7 individuals, 6 of whom had relationship with Richard Ely. And Richard Ely was the founder of the field of research called urban economics at the University of Wisconsin. He was also one of the founding members of the American Economics Association, had a distinguished career, but he's the one that started training PhDs and collaborating with others, including these 6 individuals, the 5 individuals plus Richard Hurd, who was his contemporary. And those 5 individuals, Babcock, Fisher, Hoyt, Radcliffe, and Weimer, all ended up at FHA in 1934 simultaneously, and they worked together for the first 5 or 6 or 7 years of FHA, which again is why we focus on this 5-year period, as I'll be doing. The individuals themselves were experts in the field. They've been writing about this for many years. They all lived very long lives, and they all were in the appraisal, real estate consulting field and teaching field for many, many decades after their stint at FHA. Babcock is particularly important because he was the first chief underwriter of FHA and really developed a lot of the appraisal principles. And Ernest Fisher was also very important because he was the first chief economist, and he developed, along with Homer Hoyt, many of the underwriting principles. The state of housing in the United States in 1934, there was a survey of housing that was done that was quite substantial. It covered almost 2 million structures and nearly 3 million dwelling units. 58% of the dwelling units were single family. and covered over 100,000 blocks, city blocks in the United States. This gives you an idea what the state of housing was in 1934. 62% needed minor or major repairs or were unfit for use. And so the housing stock was needed a lot of remodeling and work or needed to be demolished. The units were generally small compared to today, and if you look, leaf through this, you'll see that the homes that FHA was financing were actually fairly modest by today's standards. The owner-occupied single-family dwellings, 71% had a value below $5,000, and 79% of the tenant dwelling units rented for less than $30 a month. The point is that when FHA started in 1934, it actually, as you see from some of these posters, was involved both in remodeling work and in new construction and in financing existing housing, more of which in a moment. The housing market in the United States in 1934 was racially segregated. That was the reality when FHA was established. Of the 100,000 plus blocks that were surveyed, 85,000, or about 85%, were occupied exclusively by whites. 5,000, or about 5%, were exclusively by non-whites, and about 10% were of mixed occupancy. Of the nearly 12 million Negroes in the United States in 1930, 75% were in the South, 24% in the North, and 1% were in Pacific and Mountain states. The non-white occupancy in two cities by enumeration district, Chicago, 90% of the non-whites lived in enumeration districts that were 50% or more non-white, and the non-whites constituted 7% of Chicago's population. Jacksonville was the second most concentrated from an enumeration district, but it was in the South, and so it had also about 90% that lived in non-whites living in enumeration districts, 50% or more non-white, but that constituted 38% of Jacksonville's population. Those are just two examples that are at the top of the segregation level, but segregation was the fact in the United States in the 1930s. Racial and ethnic covenants were something that FHA, there's been a lot of written about FHA and its role in racial and ethnic covenants and lending. FHA has been rightly criticized by many for condoning segregation based on race and national origin, and it was both race and national origin. These were ethnic and racial covenants, and enforcing those local customs and practices, including these covenants, and that was wrong of FHA to do that. However, when you look at FHA's underwriting manual of 1938, which totals 500 pages, only 1¼ pages strewn in sentences here and there that total 1¼ pages actually relate to these ethnic and racial covenants and customs. The rest of it is really focused on underwriting principles and appraisal principles, as Alex mentioned. The sustainable underwriting that FHA established led to the virtual elimination of foreclosures, and their loss severity also virtually was eliminated. It ended up being 9%. And so they had a foreclosure rate that literally rounded to zero in its first 20 plus years, and a severity rate that, as I said, was 9%. The conventional market, this is before Fannie Mae got involved in conventional loans, before Freddie Mac was created, the conventional market had default rates that were about half of what FHA's were, which, as I said, pretty much rounded to zero. By the late 1950s, many of these sensible guidelines began to be discarded, and that continued over the next decades. So today, the underwriting practices that we have today are really a mere shadow of what FHA had put in place back in the 30s. Where we see most of sort of the vestigial effects of FHA's underwriting is in the Veterans Administration. The FHA actually did the military loans up until 1946, and then when FHA was separated, when the VA was separated in 1946, it went on its own way, but it kept many of these principles. There was tremendous progress in 1940 and 1960 in sustainable home ownership. The national homeownership rate reached 62% in 1960, and that's not too far off from where we are today when one takes into account borrowers that are 90 days plus or in foreclosure. We're at about 62%. What's interesting is there were 8.4 million more homeowners in 1950 to 1940. I was surprised by that. Normally you think of the 1940s as being a period when not much was going on in terms of home ownership and construction because of the war and after the war. Yet 3 million owner-occupied units in 1950 were formerly renter-occupied. In 1950 were formerly renter-occupied in 1940. In doing some additional research since I wrote this, it turns out that there was national rent control in the United States through much of the 1940s, and that basically made it unattractive to own rental units, including single-family rental units, because of the restriction on rents, and it was more attractive to sell them, and FHA and conventional lending was a convenient way to do that. I also found that non-farm home ownership is really the statistic one needs to track during this period of rapid growth in home ownership because the farm home ownership rate was quite high. The farm home ownership numbers were also quite high in the early part of the 20th century. Those farm numbers, the households, was dropping dramatically. The home ownership rate was still quite high, while the non-farm numbers of households was growing dramatically, and it was playing catch-up in terms of home ownership rate. Never did reach the rate of farm home ownership because people who lived on a farm automatically pretty much got a home with it. So that was an interesting piece of research. And also, while the non-white home ownership rate has lagged the white home ownership rate for many, many decades, during the period 1940 to 1960, the non-white home ownership rate went up at a faster rate, both in terms of proportion, than the rate for the white home ownership, and that was attributed to the improved economic status of non-whites, and there's not very good data on what FHA's volume was, white, non-white, and what the rest of the market was. All we have is these indicia based on home ownership rates. As I mentioned, Frederick Babcock was the first chief underwriter of FHA. In 1932, he wrote his seminal work, The Valuation of Real Estate, which is still to this day considered one of the two seminal treatises on valuation in the United States. And he defined fair market value would be the price which a buyer were warranted in paying in view of potential utility of the property. He did not believe that the market value of the property was necessarily the value one would lend on. It was just an indicator of value. What one would really look at is the price that a buyer would be warranted in paying based on the utility of the property, which really goes back to Hurd in 1903 when he talks about intrinsic value versus market value, and that intrinsic value is based on something other than today's supply and demand, and that usually has something to do with rents. So you already saw in the newsreel that in 1934 the National Housing Act was passed by Congress, signed by President Roosevelt. It had 4 titles. Most people forget that it had multiple parts. Those titles actually are quite interesting. Title I was the remodeling title, home improvement, which exists to this day. Title II is what most people are familiar with, which is the single-family housing finance program, both new and existing. Title III is, of course, the National Mortgage Association, which there's only one, namely the Federal National Mortgage Association, or Fannie Mae as it's called today. Title IV was the insurance of savings and loan accounts, which, of course, also had an untimely end.
Edward, but they originally thought there'd be a lot of them, right?
They did.
You'd have multiple charters.
And in fact, I have found indication that at the point when a private market participant put in to start one, which was the whole idea that private sector would start these national mortgage associations, like you had national banks, there'd be many of them, then the government came in and stopped issuing charters and basically left Fannie Mae as the only charter holder. But Title IV was, of course, FSLIC, the Savings and Loan Insurance Corporation, which also at an untimely end in the late 80s, early 90s. Turning to Title II, actually, one more thing about Title I and Title II. One of the other sort of complaints about FHA in its early decades is it focused too much on new housing, new construction. I think anyone from the home builders here would say, how could you possibly do that? But not enough on existing, and not enough, basically not enough on existing. The problem with that is that, yes, about 2/3 of the Title II business was new construction, and about 1/3 was existing. But when you look at the Title I business and look at it on a loan count basis, the majority of the loans were actually existing housing. Because they did millions and millions of remodeling loans. And if you go back to the state of housing in 1934, it was very difficult for FHA to lend for 20 years or 15 years or even 10 years on many of these properties because their remaining economic life was not sufficient. And so the idea was that if there would be home improvement and remodeling loans, that could bring electricity. There were many homes that didn't have electricity. You could bring central heat to these homes, which would then make them up to some reasonable standard, and that could be done through the remodeling program. The Title II had a number of provisions that I think have relevance to today directly. The complete amortization provisions requiring periodic payments by the mortgagor not in excess of his reasonable ability to pay. Any resemblance to Dodd-Frank's provision on reasonable ability to repay is merely coincidental, I think. But again, this dates back to 1934, but it was implemented in a much, much more rigorous way than has been implemented with respect to the qualified mortgage provisions of pursuant to Dodd-Frank. Namely, that it provided for residual income, looking at the budget of the borrower, not just his debt payments, but looking at his total budget relative to his income. Of course, that was implemented immediately in the first underwriting manuals of FHA. It also has had provisions that said the administrator could require the mortgage to contain such terms and conditions with respect to additional and secondary liens. Secondary liens were anathema to FHA and Congress in the 1930s and 40s and 50s. That, of course, has changed quite a bit. But back then, it was realized that they were quite dangerous when left unfettered. Section 205, classification of mortgages and reinsurance fund. The fundamental concept of FHA, and it was called the Mutual Mortgage Insurance Fund, which, of course, it is still called that to this day, except the mutual provision has been long driven out of the FHA structure. The mortgages had to be classified into groups so that any one group involves substantially similar risk characteristics and similar maturity dates. So they basically took vintages of loans based on their maturity date by the year they originated, put them into risk groups, and they kept track of those risk groups, and then they returned the excess premiums, if there were any, on a mutual basis to the borrowers in that group. So if you were in a shorter maturity that had lower risk, if you had lower risk for other reasons, larger down payment, you would get the benefit of that. Of course, today, FHA is totally and only about cross-subsidies from low-risk borrowers to high-risk borrowers. That's the whole basis of FHA's current structure. So the whole mutuality provision has been completely lost and forgotten. Yes? Back then, everybody did pay the same rate. It was 50 basis points. And it included, FHA had to pay their administrative costs out of that. I'm not sure what those were. Alex, you'd be interested in knowing that, because today FHA is subsidized for those administrative costs by Congress every year in an appropriation. But they had to pay those, and let's assume those were 15 basis points, I don't know, pick a number. But if you look at their loss numbers, they were quite low, because if the foreclosure rate was 0.2% and their claim rate was 0.2% and their loss rate was 9%, that's 2 basis points. So there was a lot of money left out of the 50 basis points to rebate back after a certain period of time. You have in your pamphlet, in your folders, some of the other pamphlets that were done, how you can buy, build, or refinance your home, open this door to farm property improvement, which was an FHA program again for farm properties. There's a quote from Franklin Roosevelt: to return to the unemployed to useful occupation, to raise the standards of good living, and to produce tangible, useful wealth. There was a real focus on wealth building. Is the Better Housing Program designed to foster borrowing? No. The plan is to stimulate making necessary, desirable improvements. May I take the maximum time allowed to pay back any size loan, which, by the way, was limited to 5 years on these property improvement loans. No careful banker or prudent borrower will want the maximum time if it's not necessary, nor will they approve a time arrangement that bears too heavily on the farm owner's income. Again, these are concepts that have been long forgotten by FHA and I think by other regulators, including FHFA now, have forgotten these precepts that guided FHA for many decades. 1936, How to Have the Home You Want is another that you have in your folder. And I would just start with, to many people, mortgage became just another word for trouble, an epitaph on the tombstone of their aspirations for home ownership. That could, of course, have been written about the period 2007-2008 and the lead up to it from 1994 onward, as leverage increased and we resulted in 8 million foreclosures. This new mortgage system provides a straight, broad highway to debt-free home ownership. The idea was debt-free home ownership, which is really what wealth is built on, is you don't owe money on that home. And these are concepts, again, that date back to the very beginnings of FHA. 1938, underwriting manual. There were 2 underwriting manuals before that. I've got access to 3 or 4 after that. But the 1938 one is really where they had put everything they had developed together in one place, and that resulted in that 500-page underwriting manual. They point out, again, these precepts of risk that get forgotten today. Each and every mortgage investment is hazardous to some degree. However, it's fallacious to presume that there are those that are safe. It is fallacious to presume that there are not those that are safe and unsafe. You can distinguish between those, and the way FHA did that was through a risk rating matrix that they implemented early in their years, probably about 1936. That was a natural result of Congress's admonition that they had to risk rate every loan to put them into a classification so they could operate the Mutual Mortgage Insurance Fund. So it just followed as night followed day that you had to risk rate each loan. And they looked at all the elements that they could identify, and they said, we have to identify these elements up front. We can't identify them later. We have to base it on what we know at the point the loan is made. The 1938 underwriting manual, and much of what I'll be going through for the rest is out of the 1938 underwriting manual. Essentials in risk measurement. The mortgage risk lies in the future. You're lending the money, it's out the door. Lending money's easy, getting it back's the hard part. And so they realize that, and that the risk lies in the future, and risk rating involves forecasting and predictions. It's equivalent to predicting chances or likelihoods as seen at the time of analysis. And I would just add, Alex mentioned the work that Steve and I do with the International Center on Housing Risk, but every month we publish a National Mortgage Risk Index that actually looks, based on what we know today, attempts to predict likelihoods of future foreclosure under stress for all of the mortgages at a loan level. Next Monday, a week from Monday, we'll be releasing our latest results, and we've now risk rated over 5 million purchase loans since we started a little over a year ago. And so we're really following again in the footsteps of things that were developed many, many decades ago. The weaker elements impose their penalties in greater ratio than stronger elements. That is often forgotten. It's being forgotten again today. Risk layering is a big problem. FHA understood risk layering, as we'll see, and took steps to avoid it. The underwriting manual implementing these theories, they had a mortgage risk rating score. It ranged from 0 to 100 points, with 50 points needed for approval. One of the interesting things that I found was that 73 to 84% of the total number of points had to do with the property, the location of the property, the neighborhood the property was located in. It was a property-centric approach, which makes sense since you're lending on property. The rest of it was underwriting the borrower. The reason why it varied was they actually, to this point about the riskier items tended to have more of effect than being offset by lower risk items, was that they realized that as they looked at the borrower rating, the property rating, and the neighborhood rating, whichever was the weakest based on the scoring, that got the greatest weight under the 100 points. And so the weakest one was weighted more, the middle one was made at the middle, and then the strongest one had contributed the fewest points. That, in that respect, you had to have offsetting factors that would offset the risk associated with the weakest item, which had the most number of points. That weakest item, I think, could account for 27 points, and 22 points. And so if you needed 50, and if you had a very weak one item, you had to really make up for it somewhere else, which again was part of their balancing concept that they established right at the beginning. You see how the points were distributed, and we'll be going into those in a little bit more detail. They had valuation axioms. Again, very different from what we have today. Today, the appraisal is more of an afterthought, and of course, the appraisal ends up basically mimicking the sales price to a huge extent, and because you tend to start with the sales price and work backwards. That was not the methodology that the FHA developed. They said you definitely need a sale in order to figure out what was going on, and you had to have a buyer who was well-informed and acts intelligently, voluntarily, and without necessity, as with a seller in the same manner. The goal of the valuation process is to estimate prices which represent the worth at the time of appraisal of the future benefits of the long-term use of the property, and rather than merely prices that it might bring in the market today. Valuation recognized the importance and usefulness of sales prices, provided it is determined whether or not such sales prices were fair and warranted. It goes on, basically these axioms placed the appraiser in the role of the well-informed buyer and seller. They did not assume that the buyer and seller were well-informed. They said that's the job of the professional appraiser, because what they're really doing is valuing a loan for mortgage lending purposes, mortgage loan purposes. It has nothing to do with what the seller would do on their own or the buyer would do on their own. It's really a lender, and in FHA's case, the loan guarantor, is really making the decision here, and they need to know what the right answer is. That would be based on a well-informed buyer and seller. The method of dwelling valuation, the fundamental character of value. The word value refers to the price which a purchaser is warranted in paying. And they were very particular about, we don't just look to what it might sell for today. In fact, at one point they say what a property sells for is not really an indication of value. It's only one of the pieces of data one could consider in the process, and it is not necessarily even the most important consideration. When you look at the 500 pages, about half of it has to do with valuation, and the part about the comparable sales approach takes, I think it was 2¼ pages. It's not a very highlighted part of the analysis. The differences, the marked differences between available market prices and values will be evident under both boom and depression conditions of the market. Again, this is something that, we just went through a depression condition of the market, and we seem to have already forgotten what we might have learned from that. Attention is directed to the fact that speculative elements cannot be considered as enhancing the security of residential loans. Again, I think we've forgotten that also. They define something as, did I skip one? No, here we go. Yeah. They define something as the valuation of amenity income dwelling. That's a fancy word for owner-occupied, as opposed to an investment or rental. And they understood there was a difference between what an amenity property, its attractions were, versus an investment or rental property. And it required a rigorous determination for mortgage loan purposes of the V in value. The loan amount was one thing that was relatively easy to determine. It was determining the LTV that was the hard part, because what is the V in value? And they looked at three methods: the derived capital value, the total cost of replacement, and the available market price. The most important thing in their eyes was the derived capital value. It was the essence of valuation and the major attempt to ascertain proper valuation. It was useful in evaluating differences between available market price and warranted value. And this was all based on the substitution theory in economics, that if you can substitute one thing or another, that tends to provide a boundary on its price or value. The derived capital value itself was, they had a formula for doing this, although it required a reasonable amount of judgment by the appraiser. It follows the way that the investor properties are valued, except it takes into account this amenity component. Basically, the idea was someone will pay more for a property than what it would just generate in rents. They won't pay an excessive amount more, or they shouldn't. That gets beyond warranted value. And if we look back at what happened 10 years ago, 8 years ago, properties were renting for very little, and people were paying very high prices for those properties, which indicated under the FHA methodology that those values were not warranted. They determined this through a separate estimate, through looking at the gross returns, which was comprised of the actual rental, the economic rent that was available on that property, and the amenity value, the additional increment that they would add. They would look at all the expenses and other things, and then they would come up with a capitalized value or derived capital value that, again, took into account this component of the amenity value that they would determine. They had a provision that basically said once you got above about 130%, where the amenity value got sort of out of bounds with the actual economic value, that loan should be turned down. Why? Well, not only wasn't a very good loan to be insured by FHA, but it wasn't a good deal for the consumer. The consumer was paying too much. One of the axioms of value that I skipped over was that you should be looking at whether the consumer should be buying or renting. And if rents are very low relative to house prices, then FHA back then would have said, don't buy, rent. And so they, again, looked at all of these features to make sure that from a consumer perspective, they were actually getting the benefit of what they should get, and that they were paying a warranted value. They also looked at total replacement cost of the property. That's a fairly straightforward process that roughly continues through today. And then they also looked at available market prices. As I said, that was done in a very, very small part of their handbook, and it was based on consideration of sales data for similar improved properties, et cetera. And in making such comparisons, though, consideration was given to the entire range of data useful in estimating market value. Again, something that we've abandoned long and long ago. Not only do we tend to focus on what's known as three comps on a grid, but we also have the anchoring that occurs because the appraiser starts with the sales price. And once you start with the sales price, you basically set the expectation of what the answer is, rather than doing it independently, which was the way that FHA's methodology developed. Then that covered the valuation process, which fed into much of the rest of the analysis and the rating. They had these three big sections having to do with rating the property, rating the borrower, and rating the neighborhood. Rating the property, they looked at the items that are up here. You can see how those were weighted. And those all add up to 100%, and then you could lose points at the end for adjustment for nonconformity. They basically said, well, if the property doesn't conform to other properties in the neighborhood, then you might actually detract from the rating of the property, so you could lose some points for that. And as I said, that whatever score you got there would be then compared to the scores on the other two, and then whichever had the lowest score, that was weighted 27 points. Whatever had the middle score was weighted at 22 points, and then at the lowest score was weighted 16. So that's how that balancing took place in terms of compensating factors. They then looked at the location, which again would be worth from 16 to 27 points. These again add up to 100 points. These were the things that they looked at. And then they also rated the borrower, which included many more factors than are looked at today. And we're really looking at the ability of the borrower to really handle this obligation based on what the borrower had demonstrated in the past. And it included, I think, something that Alex points to often, character. The character is based on reputation that's been established. It's more than just do they pay their debts. It's really evidence of what their overall character is. And their attitude towards obligations really had to do with what their family obligations were and how did they arrange their affairs in terms of their budget. This is why the budget was important. If they were spending money on a lot of non-essential things and that really didn't leave them any leeway for the usual events that occur that are unexpected, then they weren't managing their affairs very well. It's of interest that the housing ratio, housing debt ratio, which today FHA averages 28%, back then was 15%, and as late as the mid-1960s was 16%. Interest rates were not too different than today. They were probably 4.5%, and today they're around about 4, give or take. So you had about the same interest rate environment, but the debt ratios were the front-end debt ratios were much lower. And again, they still went through this budget process. Yes? How many? Okay. Oh, at 40. Thank you. Then they're continuing rating the borrower employment, the relation to obligations, et cetera, income. They went through all of these things in detail. Interestingly, the appraiser part of the house actually did a lot of this work. So not only was the appraiser responsible for roughly 80% of the overall risk analysis, but they actually did about half of what was left. So one of the things I noticed was from the underwriting manual that FHA had some counter-cyclical features. This is a common refrain today. Counter-cyclical, or macro-prudential and things of that nature, which everybody always has a hard time getting their arms around, and how would you do it? Well, they had three things that I've been able to identify. They had a ratio of total payment to rental value, which actually was a formula that said you take the full expense of owning the property, principal, interest, taxes, insurance at the maximum maturity that they would do, plus utilities, plus maintenance, plus whatever else you had to own the property, and you would divide that by the rent on that actual property, the expected rent on that property. If that was above 1.3, you turned it down. Again, you ended up not putting the borrower, you were putting the borrower in danger, and FHA didn't want to do that. And so that impacted the mortgage pattern because you got fewer points as you approached 130. You got the most points, I think, down at around 60%, and you started losing points, and then you got a reject above 130. As you lost points, that meant you had to compensate it more or less with something else, which tended to be somewhat countercyclical. Ratio of LTV, as the ratio increased, the mortgage pattern score decreased. Again, as you pushed out during a boom, if ratios are going up, which traditionally has happened, then your score would go down, and then at some point it would either choke off because you got below 50, or you'd have to compensate it with some other factor that reduced the risk. And then the derived capital value, of course, was designed to actually compute what the property was worth, regardless of whether it was a boom market or not. And so again, that would tend to tamp down the underwriting metrics that existed in 1938. I've got a list of them in 1934. I don't have the data for each one in every case, but you can see that LTV, loan term, actually was pretty steady at 21 to 22 years. LTV actually went down from about 86% to 80%. Property value was quite low, as mentioned before. Land value was 15%. Number of bedrooms, 5.7. You have income here, mortgage payment, 13% in 1938. It was 15% in 1954. Home value is a ratio of income about 2, and the number of homes with garages, 80%. Then to finish up, what are the lessons for FHA for wealth building? Rigorous lending standards promote low defaults and burgeoning home ownership. Both of those happened from the start of FHA through 1960. We had both. The conventional wisdom today is you have to have more and more leverage in order to increase and goose home ownership rate. We just went through a period of that ended poorly. It looks like we're starting another period. It always starts out very slow, but what this teaches us is that you don't need to loosen lending in order to have increasing home ownership rates. Mortgage risk must be measured dynamically. Each classification of risk must stand on its own so as to avoid cross-subsidization. Weaker elements need to be compensated for. Valuation-related items are primary risk inputs. Sustainable lending relies on analyzing the transaction from the perspective of renting. After the home purchase, they also looked at the payment shock of the rent, what the borrower's paying in rent today versus what they're going to be paying for the house when they buy it. Important to determine if the borrower is attempting to purchase too much home. We violate that rule all the time. Well underwritten borrower and property combined with shorter loan terms and upfront equity provide a debt-free highway to home ownership. You've got in your folder an additional sheet, update on the wealth building home loan, which Steve and I introduced in September. Neighborhood Assistance Corporation's Freedom Loan is being offered nationally through the 30-plus offices to low-income borrowers. The Androscoggin Bank of Maine began offering a market-rate wealth builder home loan last month. It has 100% of the buying power of an FHA 30-year and 100% of the buying power of Fannie's 97% 30-year loan with a 700 FICO. This is a market-rate loan by the private sector, and it equals the buying power, yet it has double the wealth building at the end of 7 years and has a third the credit risk. Under consideration, this wealth builder by almost all private mortgage insurers. Lots more to come. Stay tuned. And last but not least, you have the bibliography that I've put together of about 20,000 pages that we've put available to the public, so you can look at the history of these documents, including 5 of the underwriting manuals, et cetera. So with that, I will sit down.
Thank you, Ed. Extremely interesting. May I ask all the speakers to join me up front here, please? While we're coming, I would like to say that the advertisement at the end for the 15-year loan was not a paid advertisement. But it's certainly an idea that is worth thinking about if you haven't. And as I said in the beginning, to look back at the careful way that mortgage credit risk and underwriting was thought through those 8 decades ago, as Ed has shown us, is really quite impressive, I think. We're going to come to our discussants. We have two highly knowledgeable discussants in mortgage finance. First will be Penny Reed, who is Vice President for Strategy and Financial Reform at Wells Fargo Home Mortgage, the leading home lender in America. A 30-year veteran of the mortgage industry, Penny has been with Wells Fargo for 25 years in positions including underwriting, credit risk management, capital markets, strategic partner management, and agency relations. She currently focuses on the effects of financial regulatory reform. Perhaps in important respects, we should call that regulatory, quote, reform, unquote. But anyway, the effects of the regulatory changes on Wells Fargo's many partners in providing mortgage finance. Our second discussant will be Steve Oliner, a resident scholar here at AEI and a senior fellow at the UCLA Zillman Center for Real Estate. Steve is, of course, the Oliner in the AEI Pinto-Oliner mortgage indexes. He joined AEI after spending more than 25 years at the Federal Reserve Board working on analysis of the U.S. economy and financial markets, and maintains an active research agenda focusing on real estate issues and the U.S. economy's growth potential. Penny, we look forward to your comments.
Hello. Ed and I have talked a lot over the years on this particular subject, and I have a lot of passion around it. And just as a note, I'm speaking as a person from the mortgage industry for a lot of years versus necessarily the opinions of my employer. I have to get that out there. But I actually have been around for a long time. Those of you who are local to this area, I started in the mortgage business as a receptionist in the mortgage lending department of Perpetual American Bank. If any of you remember that. But no. But the business got me hooked right away. Of course, back then we were quoting interest rates of, fixed rates of 19%, and we had a one-year ARM with a start rate of 14%. What a deal. And things are definitely different now. But one of the things, because of the way I came through the business, coming up through processing and underwriting and then into things like capital markets and agency relations, I've watched the business and the way we make mortgage loans change over the years, and haven't necessarily been that happy about some of the changes in that they don't necessarily protect the consumer in the way that they used to. And my start was working a lot with VA loans. And back in the day, when you worked on VA loans, you talked to the VA office a lot. You would get advice. You would ask them about specific transactions, and their response back to you, if you had something a little bit questionable, was, how does that benefit the veteran? So you had to stop and think about, how does that benefit the veteran? And if it didn't, you were probably not making a good decision on behalf of that veteran. And it taught you a whole different way to underwrite. And one of the things I've seen that it really comes clear when you look at how things were back in the beginning here with the 34 to 38 is how the changes that we've made over time to open up lending to more borrowers has actually sort of skewed the business with unintended consequences that in some ways penalize certain segments of the market more than others. A big one that we always have the conversation about, and Steve Linville's here from the builders, is when you look at builders today trying to build homes with renewable energy sources. The way we make loans today penalizes that market. It makes it almost impossible for the builder to recognize the additional value that they would get out of putting the cost that they have of putting that renewable resource in there, because we don't consider the reduced utility expenses when we qualify borrowers. So if you're a borrower and you can buy a house $20,000 cheaper or $10,000 cheaper, or even the same price but that much bigger, just because we are not looking at your utility expense, how does a builder justify spending that extra money? So you have a market that is encouraging builders to not do what we probably know is the right thing to do for the future. And it's those kind of things that crept into our guidelines over time that are the ones that I have a lot of passion around. And a lot of it has to do with the way we value properties today. And in some ways, the way we want to force appraisers to value properties today, I think there was a state on the East Coast here somewhere, just north of here, that actually tried to legislate appraisers adding value for renewable energy. You can't legislate value. It is what it is. And so until you change the way you're looking at it in a transaction, it's not going to appear magically, and you can't legislate it in. So, really would behoove the industry to take a better look at how we're doing this. Today's appraisal gives us a lot more data, but a lot less information is the bottom line. There are huge number of data points that are in there. It's much more difficult for the appraiser to complete an appraisal today because of the volume of data points they have to have in there. But at the end of the day, we have less information about that house, about what it costs to own that house, not just what it costs to buy it, but what it costs to own it. And that's a really important factor when you're looking at how you're qualifying loans. And that's kind of the stuff they took into consideration back when they were first doing this. So if you have, for example, a 15-year wealth builder loan, and you're looking at your all-in expenses, and you're buying in an area where there's employment close by, you're not going to have a long commute, which is another big passion of mine, where there's a lot of employment centers nearby, you are going to be able to wealth build and be in that house and sustain different economic environments because of the employment centers. On the other hand, if you're in San Bernardino County, for example, California in 2007, and gas prices double or triple, and you're driving to LA to go to work, you're not going to be able to make your mortgage payment. And when we as an industry stopped looking at all those bigger pictures, especially what information an appraisal could provide about what, not just what's in that house, what it costs to own the house and what it costs to live in that area, we unconsciously started encouraging what would be bad behavior and discouraging what would be good behavior. And by good, I mean to the benefit of the borrower. So we started encouraging people to move further out and bigger houses, because you could get a bigger house and it didn't matter how much it was going to cost to heat it. And no one was telling that first-time home buyer to stop and think about how much it costs to heat it. That's not what they're thinking about at the time. And none of this was done intentionally, I think, on the part of the people who made the guidelines. But at the end of the day, that was the end result. So how, as an industry, can we work our way back to incenting behavior that benefits the consumer, benefits home ownership, and benefits the economy? So if you think of, their whole approach to modernizing properties, there's a lot of properties out there that could be modernized with renewable energy sources that would create jobs to do it. But today we make it very difficult to either finance that or recognize that value because of the way we qualify. Am I good on time? Okay. I wrote down a couple of things that, I remember from, if you think of residual income, and it came up in Dodd-Frank, it's not, it hasn't been applied in the way today as it used to be in the past, where you actually looked at all the consumer's expenses. There are some folks who actually look at it and think that would disadvantage lower income consumers, but when you look at the old residual income calculations, you also look at income taxes. And it evens those things out. The lower your income, the lower your income taxes, so your residual income tends to be a little higher because of that. You also have less of luxury expenses, or you're buying a smaller house because that's what associates with your income. So you have a list of optional expenses that you wouldn't necessarily have to count. So you don't really have to have a $300 a month cell phone bill. But you have to have, and VA and FHA used to have sort of schedules of, if you have a 2,000 square foot house and it has this source of energy, you're going to probably have X number of utilities in that market because it's telephone. They were figuring out what the minimum was, and you could lop off all your optional type expenses. Example is, if you looked at a borrower's pay stub back then, and even today, today it would be a 401k versus putting money in a retirement plan, that was optional. So you can't penalize them for savings by not counting that as income because they could stop that if they got into a tight spot. So there are a lot of ways when you use residual income where you can better match consumers to the type of house they can afford and stimulate the whole economy at the same time.
Perfect, very interesting, thank you, Penny. Steve?
Thank you, Alex.
Up on the,
Right.
there you,
Thanks. So I'm sitting in the chair that was to have been occupied by Dave Stevens. Obviously, I'm not Dave Stevens. He unfortunately couldn't join us today, and I'll try to fill in and offer some brief comments on Ed's presentation and segue into some of the work that we're doing here at AEI that I think really builds on the insights about how the FHA acted as a responsible mortgage lender during the first 2 decades of its existence, which Ed has provided invaluable history about. So obviously I'm not an unbiased observer. Ed and I work together very closely as co-directors of the center. We speak many times a day, including the 7:30.
that's odd, Steve, because all of the rest of us are completely unbiased.
Exactly. You know, phone calls at 7:30 in the morning sometimes begin the day. But anyway, with that disclaimer, let me just say I think what Ed has done is absolutely a monumental achievement. Putting together the information that he has, uncovering what really was lost about how the FHA acted in a completely responsible, well put together program at the beginning of its existence has really been lost. And I've been a party to numerous conversations where Ed has been talking to people who are knowledgeable about real estate, in many cases prominent academics, whose response is, I had no idea that any of this was true. Please send me all of the information that you have. So I think what Ed has done, just to reiterate, is really a very important contribution, not only to our practical understanding of housing finance in the early days of FHA, but also as a guide to how we can reconstruct the housing finance system in the United States on a safe and secure foundation as we think about what we want for the future. So let me offer some comments, as I said, that link to work we're doing here at AEI that I think illustrate some of the points that Ed made. As Ed indicated, we publish every month the National Mortgage Risk Index, which is a stress test of essentially all of the home purchase loans originated each month with a government guarantee, which in today's market is, roughly speaking, 85% of the loans. It's a huge part of the market. And the numbers that we get from our risk index really illustrate shockingly how far FHA has lost its way. So the numbers in the index are a stress test that says if we were to have a repeat of the financial crisis that we went through in 2007 and 2008, based on the actual performance of the loans originated in 2007 over the next 5 years, how many of today's loans would we expect to default under those circumstances given their characteristics? So based on that stress test, roughly a quarter of the loans that are being guaranteed by the FHA today would default if hit by the kind of tsunami that hit in the financial crisis. That is way, way above the percentage that would default based on the same test for the loans that are guaranteed by Fannie and Freddie, roughly 4 times higher. And it's even double the percentage that would default among the loans that are guaranteed by the VA. So it shows just an enormously risky program that the FHA is running today. In contrast to that stress default rate of nearly 25%, risk rating the loans that the FHA guaranteed in its first 20 years of existence provides a sharp contrast. The risk rating on those loans would be about a 3% default rate, so almost 10 times lower than the loans that the FHA is guaranteeing today. Another perspective is really just how ineffective the QM regulations are at trying to guarantee that we'll have a safe and secure mortgage market, because every one of the FHA loans that are guaranteed today are qualified mortgage loans. Nonetheless, they're incredibly risky on the whole. And if we do have another severe financial crisis, they're going to perform very badly. So they're qualified, but they're not safe. So thinking about housing finance reform, there are, of course, several bills that are out there. They differ substantially in their particulars. None of them have been acted on. The prospect that they will be acted on in the near future is probably pretty low. But from our perspective, they all suffer from a common deficiency, which is that they think too small. They would really continue to have the 30-year fixed rate loan as the centerpiece of the housing finance system. Some have a federal backstop guarantee, some don't, but the 30-year loan still sits there as the centerpiece of the housing finance system. And for us, that's problematic because, as Ed was recounting, the 30-year loan has not served the country well in at least two respects. One, it has not sustainably increased home ownership. It's gone up and it's gone down, but we're basically back to where we were 50 years ago. And perhaps even more importantly, it has not served as a tool whereby home ownership increases wealth. The loan pays down too slowly, and the house price gains that are really necessary for there to be much equity accumulation with that loan are too unreliable. As we've witnessed over the past 10 years, house prices rise and they fall, and you really can't predict where they're going to go over the intermediate horizon. And that's really a problem for homeowners that are actually only buying one house. It's a completely undiversified portfolio, and at that level, for an individual house, the prospects are very uncertain. So that leads to my final comment, which Ed touched on as well, which is that we think really the much safer way to reconstruct the housing finance system is going back to what were the typical loans at the time of FHA's inception. And we've tried to do that, roughly speaking, with the Wealth Building Home Loan Program that Ed mentioned, and that we're very gratified has gotten a good reception in its very early days, and that we hope over the coming year will become a much more widely available mortgage product. But its key features really do mimic much of what FHA did, which is shorter term loans. The wealth building loan is a 15-year loan. Rigorous underwriting that is rooted in the household's budget and the residual income concept. Rigorous assessment of home value, not just the three comps on a grid. Provision of really substantial insurance against negative equity because the loan pays down so rapidly. We've done a lot of simulation work at the individual house level about how these loans would have performed during their financial crisis relative to a 30-year loan, and they would have resulted in much, much lower incidence of negative equity, and therefore much lower incidence of default than we actually observed. And finally, because there is a substantial amount of homeowner equity in the loan after just 3 or 4 years, once you hit the typical part of the life cycle where defaults tend to be the highest, beyond 3 years, there's substantial equity, and that really makes remediation options much more plausible to work than when you have a homeowner with no equity. So anyway, I'll stop there, but let me just reiterate that I think what Ed has done is fantastic. It's a monumental achievement, and it, I think, sets us on a course for describing what should be the way that we reconstruct the housing finance system.
Thanks very much, Steve. And I will let you know that Steve was recruited at about 10 minutes to 12. Excellent job. Thank you very much. By me, when we found out that Dave Stevens, being, of course, part of the political complex as well as the mortgage complex, had other duties. But we appreciate a lot your appearing, Steve. And also Penny. Let me give Ed 2 or 3 minutes, if you'd like, to respond to the comments by Penny and Steve.
Thank you, Alex, and thank you, Penny and Steve, for those remarks and the kind words. Picking up on something Penny said, I've talked about the wealth building legacy from FHA, but Penny really also puts it in the consumer protection legacy. And I'd say they're really connected. I mean, if you're building wealth, you're protecting the consumer. It's as simple as that. And this idea of residual income, which I just today, one of the other things I've done is I've gone out and bought as many old appraisal books as I can find, going back, as I said, to 1903. I've now got about 30 of them. And I also try to find all the different editions, because you can actually, it's like tree rings. When you're doing research, you can actually see how things have changed. And I just looked at one this morning from 1967, and it had the 1964 FHA budget analysis, which is actually a full budget analysis. It was not a residual income analysis. It was a full budget, and that's interesting. Penny pointed out, utilities, commute costs, retirement expense. I mean, these are things that are ignored. Taxes, they're just ignored. And it's like, excuse me, how can you ignore those things? And what it does is, because the house is looked at like a silo, separate from retirement and separate from a family's need to provide higher education for their children at some point, it's a silo, and it's viewed as, we don't have to worry about the rest of it. We'll crowd all that other stuff out with the way we underwrite the loan. Let's put the person in the biggest house possible. Who cares about retirement? Who cares about their children's education? And so the wealth building home loan really looked at the life cycle of savings. Steve mentioned about what was lost with FHA. It literally was lost. Even today, I get some more recent books, and it'll be a 150-page book on housing policy or whatever, and you look up FHA, and it literally will dismiss FHA in a sentence, which will say something like, they embrace ethnic and racial covenants, end of discussion. And then they move on. And so this whole success that they had of putting 3 million people into homes, 3 million loans from 1935 to 1953 is just glossed over as if it didn't happen, and their default rates and everything else. Steve mentioned the 3% default rate. I mean, we found enough information about what FHA's underwriting guidelines were and what their averages were that we could basically put together a loan that roughly we could distribute the loans and put them against our what we call our periodic table of risk, and then come up with that it was about a 3%. So that was also interesting to see, and that's why FHA's default rates really literally rounded to zero during that time period. So thank you for the opportunity.
Thanks, Ed. Penny or Steve, any other comments you want to make?
I did have one that I just want to bring up, because it's something I hear a lot of times when I talk about these kind of things. You'll hear that, but that will keep the price of housing down. And so you're never going to get a buy-in from the people who spend their life working on commission, right? Realtors, loan officers. I served my time as a loan officer, I'll say that. I didn't have the personality for it because I was kind of like, you really just need a small second. But on the other hand, I could tell you during my time there, I would much rather have done 7 $100,000 loans than one $200,000 loan. And so it's just a question of educating even the market that works on commission, that if you get the housing market working in a way that benefits the consumer, it's going to benefit everybody that works on commission too. It's just higher volume, lower dollar amount, but at the end of the day, they'll make more money.
Just certainly add on that, the way Steve and I have talked about this a lot, the way we look at this is, yes, the person may be buying a slightly smaller house, and that may tamp down house prices slightly, but when you expand the number of people that can buy homes, we think it counters that. So we think this actually, one of the questions we have is, how do you shift to a new approach and don't crater the housing market? We think this does precisely that.
I will jump in here to say that lower house prices is good for people who are buying houses. Lower oil prices may be regretted by people selling oil, but are very happy, make people buying gas very happy. Same with houses. Steve, any other comment? All right, we're going to move on to a question and answer period. I do want to point out, though, before we do, one thing Ed didn't mention is in this FHA material, which he has found, and have they got the pictures of the dream house in the books?
yes.
Okay. Are these marvelous pictures? Now, just speaking about how much house do you need, of what the FHA was talking about, and they're very nice-looking bungalows, but we're talking about modest houses, these $5,000, $4,000 and $5,000 houses in the dollars of the day, 2 bedrooms and 1 bath, and as one of our mortgage colleagues said, well, that was, an indoor bathroom was something I didn't have when I was growing up, he said. And that was the American dream. And it is, in part, all about balancing the size of the house and therefore the price of the house with the family budget. And it just makes so much sense, doesn't it? And they had that well figured out in 1934.
And, at the end of the day, for people to remember, for a while there, people were paying cash for houses just because you could buy them inexpensively, unfortunately. But for the most part, people use a mortgage to buy a house. So mortgage policy drives the type of houses that are available. It just does. So, whatever restrictions you put on mortgage policy, that encourages builders to build a specific way, it encourages existing homeowners to certain behavior, and it encourages borrowers to certain behavior. So the mortgage, even though it was intended to be the facilitator of buying a home, actually started driving the buying behavior.
Okay, now we're going to move to your questions, and that's everybody here, but also those who are with us by electronic media, who are going to have the chance, if you all want, those of you out there, to send us a question by email. If you do, you need to send it to Leela Lukacs at aei.org, who will get your email, and we'll have a chance to see what you may write in. It's lilla.lukacs@aei.org. Now, but however, we'll first take questions from people who are actually here, physically as well as in spirit. May I remind you, before we start, of our rules. Please wait for the microphone to get to you. Tell us your name and your affiliation, and then ask your question. And I always have to warn groups at AEI that if you insist on prefacing your question with a statement, the chair will tell you when your statement has gotten too long, which will be not very long. Okay, I think I had a question over here. Let's start back here. Question here? Okay, go ahead.
Thanks. This is Jeff Naiman from Buckley Sandler, which is a law firm that represents financial services institutions. The question I have, it's really for Ed, has to do with the extensive work that you did on the alternative appraisal algorithms that were used by FHA, as opposed to just kind of the three local comps, and whether have you done any modeling, have you or Steve done any modeling as to how those alternative mechanisms would have done kind of through the most recent economic cycle? And secondly, whether any of the modern kind of AVM and kind of other kind of computerized valuation mechanisms use anything other than comps, because I think the ones that I'm familiar with, kind of seem to be very comp driven. They may be better or worse about it, but they're very comp driven. I don't know if anyone else is using rents or other things that you identified as being part of FHA's kind of heritage.
Thanks, Jeff. So in the first question, Steve and I have started talking about how to model and replicate through period. We may look at Prince George's County, Maryland, which was ground zero for the catastrophe, mortgage catastrophe in Washington, D.C. area. Not completely well recognized. Most people think Washington came through it pretty well. We've been doing a lot of research on that. We've already tested what's the wealth building home loan, which is really a proxy for what FHA did in the 30s, 40s, and early 50s. And as Steve indicated, it came through with flying colors. So we know the mortgage instrument itself will. What we then want to do is apply their methodology, and we think we can get most of the data to at least replicate a good chunk of it and then run it through that cycle. So that's work to come. As far as your AVM question, there, to my knowledge, are no well adopted AVMs that do anything other than look at more or less the comparables. They may look at lots more of them, they may do it objectively, et cetera, but they're still looking at comps. They're not trying to deal with the warranted value or where you are in the cycle. There's some work going on in that area, but it hasn't gotten really to the point where it's been adopted by very many, although I think 2015 could be a breakthrough year.
And I got another question here, yes, right here, and then we'll get you, Frank, and I think I had a question over here. We'll come over in a minute, just be a little patient, yes.
Yeah. Ed Kitch from the University of Virginia Law School. I would appreciate it if you'd focus in a little more detail on the role of the down payment and the way the founders of this system thought about the down payment and its role in the structure of mortgage finance.
The basic approach they had, and they started with in the 1920s and 1930s, mortgage structure was commonly either a balloon payment, but that was actually a minority of the loans that were done through banks, 5-year balloons. Virtually, and then the other common structure was thrifts and savings and loans had 10 to 12-year fully amortizing loans, although some of them had sinking funds versus fully amortizing, but it still had the same goal. What was really an issue was that as late as 1931, 75% of all the purchase loans on the West Coast, based on a survey of realtors that was done as part of the President's Housing Commission in 1931, had second mortgages. And so when you look in these brochures that you have, you'll see that they really wanted to get rid of the second mortgage because the second mortgage was the way around the down payment. And so what would happen is the seller, and it was usually seller provided seconds, although there were institutional seconds, seller provided seconds. I'll sell you the house for $5,000. I'll give you a 20% second. Well, the house would normally sell for $4,000, and then they built it into the value of the house, and it inflated the value. And in the underwriting manuals, they talk about that quite a bit. So their goal was to do away with second mortgages, to have a minimum of 20% down, although the average was closer to 25%, to have a term that didn't exceed 20 years initially. That Congress kept pushing that out, but the average again in the early years was 17 or 18. And they viewed all of that together, and so their risk grid, if you look at the risk grid, you'll see all those things balance each other, but they thought a down payment was very important to the process as skin in the game by the borrower, and they talk about that a lot in the underwriting manual.
In one of these wonderful brochures that Ed has found, there's the line that, and you can do this for as little as 20% down.
And by the way,
you want to make a comment?
I stumbled on these brochures and things. I get an email from George Mann, who was introduced to me by Joan Trice from the Collateral Risk Network, and I get an email one night saying, "Oh, do you know there's FHA memorabilia on eBay?" And I said, "No, I didn't know that." And the rest is history, as they say.
One thing I'd add on the down payment side, just to remember sort of the proof in the pudding is to look at VA. And the importance of those credit guidelines that VA uses versus the down payment. Because VA, of course, has no down payment requirement, and yet you can get good performance out of those loans. And it is because of that very trade-off. It's putting those guidelines in effect that are meant to protect the veteran, help offset the lack of down payment. It's when you have conventional guidelines and VA down payment that probably doesn't work.
Just to remind everybody, in case some of you may not have thought of this, the difference between VA delinquencies and defaults and FHA delinquencies and defaults, which are VAs are enormously better, is one of the really striking empirical facts about our mortgage system.
One final comment. The wealth building home loan that we've been talking about really follows the VA model with respect to the down payment. It has no required down payment, but nonetheless, because it has very budget-oriented underwriting, early year defaults are low, and by the time you get to a point where they're likely to be a more significant number of defaults, the borrower has a lot of equity because the loan is paying down fast.
Frank? Yeah.
Hi, Frank Notaft, Freddie Mac. Thanks for the interesting background on FHA's early years, Ed. It was very interesting. And one point you emphasized was the importance of property valuation, and that's really key. And I was just curious, back in the 30s, were appraisers typically an in-house department at a lender? Were they typically external? Was it a mix? And did the underwriting manual state like a minimum education or certification to be an appraiser?
Great question. Joe and I were looking at some of these old books yesterday, and we found, I think it was 1938 or so, and it talked about what the right fee is for an appraiser, and it was talking about the Homeowners Loan Corporation. I think was it $5 or something, and then it said, and the normal fee was it $8, but FHA pays $10, and the reason FHA pays $10 is because it was organized by people that really knew the value of valuations, namely the people I mentioned, Babcock and Fisher. Most of the, as best I can tell, in the early years of FHA, most of the people that did the valuation were employees of FHA. They ended up bringing some contract people in eventually. They did a lot of shared work, meaning they did the work once. And so if they did comps, they would then put them into a file and everybody could use those. When they had, for replacement costs and everything, they used Marshall Swift and other things like that, Marshall Swift Beck. And so they were very well organized. It wasn't, let's do one, throw it away, let's do the next, move on, throw it away, which is the way we do it now. Nobody uses any of the existing work. It's just sort of thrown away. And if a lender were doing the same loan 6 months apart, they would order 2 completely new appraisals from 2 completely different people potentially, never look at the old one. I mean, it's just a crazy system. FHA was very well organized in that respect. Most, as best I can tell, based on the forms themselves, the thrift industry, which was the main part of the rest of the industry back in the 30s and 40s and 50s, although life insurers were also fairly substantial, they had in-house valuators, but they were generally not necessarily trained appraisers, or they may have had some experience, but they were loan officers, and they would literally keep card files of information and drive around and come up with the value of the property. Now, those loans had terms when FHA was averaging 22 years, they were averaging 14 amortization, and they were averaging down payments when FHA was averaging 18 or 19% down. They were averaging 30 or 40% down, and seconds were still basically few and far between because they had such a bad reputation. So the lending by thrifts was very, very low risk, but they also made a lot of loans, and they performed extremely well.
I'm going to this side, a chance here. Yes? Right on the other side. Thank you.
Comment first, Penny.
You have to tell us who you are first.
Oh, I'm sorry, Joan Trace with Altair Group. Penny, I thought your comment on more data, less information was genius. Just want to go on record as saying that. And I'm not sure this question is for Ed or for Penny, or maybe both. Has anybody done any research on the relaxation of the FHA roster, appraiser roster requirements when they said no more testing? Was there any study done on whether or not appraisals have degraded since then? And then also the relaxation of fewer and fewer field reviews. There used to be a tremendous amount of oversight by even Fannie Mae and FHA going behind the appraiser and looking at them and making sure that they did indeed do what they say they did.
That brings up a really good point. So it's hard to tell when FHA abandoned some of this stuff because it was a continuous process. It's like that game of collapse where you have the marbles and the sticks and you're pulling things out. Oh, this couldn't possibly affect anything. And you pull the next stick out and eventually the whole thing collapses. Well, early in the 90s.
But not for a while. That's the key thing.
Yeah, it takes a long time, and then what's also, it's a negative feedback loop or I guess whatever it is that reinforces what's going on, because delinquency rates, as you increase leverage, delinquency rates get tamped down, and everybody says, see, we did all this and nothing happened, until finally you're left with nothing. And the whole thing collapses, which is what happened this last go-around. But in the early 90s, FHA abandoned the last vestiges of its underwriting practice, its appraisal practice, including the roster and including approval of appraisers and things like that. And there is a GAO report from 1998 that was presented to Congress, of course, and that talks about how properties with, you could see the sky through the room, the holes in the roof and stuff, were appraised as being in good condition. And so there is that appears to be when it was. You bring up a very good point, which comes back to the VA. The VA to this day still has a blind appraisal panel, still approves all the appraisers, still disciplines the appraisers, and provides very different instructions to the appraisers than what is done in the rest of the other 90% of the industry.
And one thing I will say on that note, and some of it might depend on who the lender was regulated by at the time, but as FHA started to eliminate requirements, lenders had to start adding them, right? So in order for us to know that collateral was being managed adequately, we had to start doing what they weren't doing anymore. So it was much more aggressive panel management, a lot more reporting, but unfortunately, during that period of time, it did probably rely a lot on who the lender was regulated by. So when the OCC came to us, we thought they weren't joking, and yeah, you actually have to do that. It didn't necessarily happen with the rest of the lending community. There were non-bank lenders and a lot out there. So it ultimately made the mortgage process a little more expensive because of the internal work that lenders took on, but it was a very eye-opening experience too. I know back in the late 90s, we really started tracking in micro markets what appraised values were coming in relative to sales price. Refinances were hard to look at because the borrower's estimate of value was always based on how much money they needed versus any actual market value. Right. And well, we started tracking that, and if you have, one of the conclusions we came to is if you have an established panel, so you're using roughly the same experienced appraisers in the same market over time, regardless of whether the market's increasing or decreasing, on average, 5 to 8% of appraisals come in lower than the sales price, which would make sense because you have a certain category of borrower who's in a hurry, they want a school district, they're willing to pay up, right? It's when that number started creeping one way or the other that you knew something was wrong with the market. So it was a huge, when FHA stopped doing some stuff and we started doing it, it was a big learning experience for us. We could tell, and I know we got beat up a little bit further away. We restricted LTVs in Phoenix because we could see that we were starting to get 12 to 15% of the appraisals coming in low. Well, that meant something. What did it mean? And what it meant was the market was overheated. People were paying too much for their house. And, tracking those kind of things helped a lot, but it's not done anywhere centrally anymore. It's not really.
Which, as you say, was certainly bad for the borrowers, at least many of the borrowers. I'm going to call on Leela.
Okay, we have a question here from Christopher McCod. I apologize if I'm saying the name incorrectly. From Acceptance Group about the wealth building home loan. And Christopher is wondering, what is the down payment requirement for the wealth building home loan? Could they work in conjunction with the GSE guarantor programs, utilizing the wealth building home loan residual criteria or not?
So as I mentioned before, there's no required down payment. There is a requirement that some amount of money be used at the outset up front to buy down the interest rate. It could be the amount that had been intended for the down payment or another amount. The buy down is an important feature of the loan. It slightly increases the amount of house you can buy, but perhaps more importantly, it gives the borrower a below market rate for at least the first 7 years under one program and the life of the loan under the other. And because the rate is below market, it gives the borrower an incentive not to default on the loan, and therefore will tend to reduce default risk. It also reduces prepayment risk, which is important to increase the class of investors who might be interested in holding this loan. So there's no required down payment, but there is a required buy down. This loan is one that is intended to operate without any government guarantee at all. So the loans that are being made now are ones that will have no government guarantee. If one of the GSEs were interested in purchasing these loans, that would be fine, but the program is really structured to be one that can operate outside the government guarantee.
Thank you. Did I have another question over here? Yes.
Hi, Carmen Hicks. I'm a presidential management fellow at HUD, and I just am wanting to hear from any of you about how this would actually benefit people of color and low-income populations. I'm really struggling with this, knowing that these principles, that the wealth builder loan or any of the principles that you guys have been talking about today, when they were in implementation, were highly racialized in the way that they were carried out. And so I know that you had touched upon segregation and how FHA was really instrumental in that. And I just want to know how this is not going to perpetuate that.
Ed is all ready to answer that question.
Yes. So again, looking at the wealth building home loan, what we know based on the first market version of this, it can emulate the buying power of an FHA loan. It can emulate the buying power of a Fannie Mae 97% loan. We know that that's on a market rate basis. We know that with a small subsidy of 3 or 4%, you can have it where individuals with 70 or 80% of median income, low-income individuals, could qualify for one of these loans. We know that the Neighborhood Assistance Corporation of America, which has embraced the wealth building home loan throughout all of their offices, they expect 25 to 35% of their loans to be what they call the freedom mortgage over time, and their median income is 80% of the median. Their median borrower has 80% of median income, and therefore, and I believe their numbers based on race are also quite high. I don't recall them, but I think they're quite high. But I know their income numbers are quite low. And I think of the programs I've seen, they're probably the one that's the most successful in really penetrating to have an 80% median income of the borrowers, and that's of the borrower, not just of the neighborhood. And so we think this is going to have broad applicability. And as time goes on, we think there's going to be a lot of creativity around it. We've got about a half a dozen foundations that have contacted us in urban areas and around the country that, again, we think will work to the benefit of neighborhoods. We think ultimately this is a real neighborhood positive program. Why? Because you need stable financing and stable home ownership, sustainable and wealth in those neighborhoods to actually create stability. And that's what has been largely lacking. When I did a little bit of research on one neighborhood that one of the foundations came to us, it was in Chicago, and we researched the neighborhood. We found an article from 1978 talking about FHA had done this neighborhood in. And look at what's going on today. FHA's doing it again. And it was a neighborhood of color. And so we think we have to break that cycle because it has been a cycle. It's been one that's going on for a long time. It has to be broken.
One thing I just would add to that, actually two. One is to point to VA again and look at the diversity of their borrower base because of who veterans are, essentially. And because of the way they qualify, it doesn't disadvantage one veteran over another. And when you look at it, if we can move to a market that is more residual income based or takes all housing expenses into consideration, in today's market, an urban borrower who's trying to buy a house and they live next door to the subway station and they're 2 stops from work, they're qualified exactly the same way as a distant suburban consumer buying a 4,000 square foot house that has to commute into work. And it just doesn't make sense. It is actually disadvantaging the urban borrower. where if you look at all expenses, it goes back to, it really levels the playing field to what is best for that consumer.
I just want to add here, all of the panelists have said this, but it bears repeating, which is making a bad loan is not good for the borrower, it's bad for the borrower. And when we follow this logic of working through the real budget, doing the real underwriting, and matching what you can afford to buy soundly, that's good for the borrowers, and that's all borrowers. We're going to have time for one more question, and we'll call on this gentleman here, please.
Well, but waiting for that, if you Google drum major syndrome, sermon by Dr. Martin Luther King, 1968, he speaks to this point precisely in his sermon, not buying too much house. He's actually talking about house purchases and buying too much house, drum major syndrome.
Good. Thank you. I would first like to thank Mr. Pinto for making available...
Would you tell us who you are, please?
Oh, I'm sorry. I'm Michael Youngblood with Five Bridges Advisors. I'd like to thank you for making available this wealth of historical information on appraisal practices and property valuation. It's a great undertaking and enormously valuable contribution to what we do in the academy as well as in businesses like mine. The question is, there is a theory called ruthless default that argues that it's only the change in the value of a property that motivates a borrower to pay or not pay on the mortgage loan. Has your research given you any insights as to the credibility of this theory?
Well, FHA in the underwriting manual addresses this to some extent. They talk about loss of a job, health care expenses, death, things of that nature. But then they keep coming back with, if those events happen, then the equity is what you fall back on. So that's number one. Number two, the experience of Joseph Smith, who's the monitor under the National Mortgage Settlement that was entered into a number of years ago, and he's been the monitor for the last 2 years. He spoke about what he's learned, and he says there's a trifecta of things that happen, and it's the same trifecta roughly that FHA talked about: medical problems, unemployment, divorce. It was a more recent item, and he said he finds that it's very common. And then that is exacerbated by the fact that there's just not enough equity. Steve mentioned about the volatility. What we found, and we have what we call the spaghetti chart, and it actually goes back to the late 1970s. Volatility has been a fact of life in the United States for a very long time. There are many areas that are relatively not volatile, Omaha, Raleigh, North Carolina, but there are many areas that are extremely volatile, California being what I call the poster child for that, and goes through multiple booms and busts. Riverside, San Bernardino then being the par excellence example within California. And so the problem is you can't exactly tell, and then as Steve said, you're not buying in a metro area, you're not buying a county or even a zip code, you're buying one house, and the volatility at the one house is immense. And therefore, you really have to protect against that with either upfront equity or with amortization that happens rapidly. That's how you protect against those vicissitudes of life.
And we know some go up more and some go down more, but they all revert to the mean. That's over some medium term. Ladies and gentlemen, we have reached our hour of adjournment. Thank you very much for being with us, and let's show our appreciation for an excellent panel and a great presentation by Ed.